ARK Invest CEO and Chief Investment Officer Cathie Wood recently joined CNBC's Squawk Box to break down what she believes is the single biggest stock market opportunity of the next decade. She dives into where the markets may be heading into 2026. In this video, I'm going to show you that exact clip of Cathie Wood explaining her thesis in her own words. After that, I'll walk you through my personal reaction and break down what I think investors should actually take away from what she said. Then, I'll go a step further and translate those insights into real opportunities by giving you a deep dive into two high-potential fintech stocks you can start building positions in today with just $1,000. If you find value in this breakdown, hit the like button, share the video, and let me know your thoughts in the comments. Subscribe to the channel so you don't miss future updates. Now, let's hear what Cathie Wood had to say.
Cathie Wood is here, ARK Invest CEO and CIO. 2025 was quite a year, both up and down and back again to some degree. When you look at some of the big holdings that you have, whether it be Tesla, maybe we get into crypto and everything else, where do you think things are headed? And to the extent that there were things that you were wrong about, frankly, in 25, what was the lesson?
Sure. Well, great to see you. Happy New Year, Andrew, Becky, and Joe. So yes, last year, Morningstar, in the Morningstar rankings, I think we had three of the top five, or four of the top five were ARK funds, top performing. Of course, we had two big corrections. We had the trade turmoil in April. That was an amazing buying opportunity. And what we do typically is concentrate towards our highest conviction names when we have an opportunity like that. We did that. Same with the government shutdown. That was a little less severe. What did we learn? Well, one of the things that we've learned over the last few years is we can see inflation coming down clearly, but in the reported numbers, it is stuck. And I think a lot of people are wondering, wait a minute, this market is near record high valuations. How can this be? This is a setup for a correction. And we're looking at other periods in history. If you look into the 90s up to 97, I think it was, and in the 2000s, the early 2000s, we had very strong markets as the multiple moved down. So what does last year teach us? We must assume that valuations are going to compress, and we do. We do that in our bottom-up analysis for every company. But we're pretty excited about the inflation outlook thanks to oil prices, housing prices, big time. You see the home builders, KB Home, cutting its prices by 7%. And others following, and productivity gains, unit labor costs coming down dramatically. I think on a year-over-year basis, they're up 1.2%, but the last quarter reported they were actually negative. So there are a lot of deflationary pressures, and the last one I'll cite is technology. Our focus is exclusively on technologically enabled innovation. And in each of the five major platforms, robotics, energy storage, artificial intelligence, especially blockchain technology, and multi-omic sequencing, healthcare, I saw the CEO of Bio, very good. Those are all very deflationary in their impact. So pretty excited. We think the surprises are going to be on the low side of inflation expectations.
Tesla has always been one of your big holdings. In terms of just sales, obviously things have been challenged, but there's a lot of excitement about autonomy. There's a lot of excitement about the Optimus robot. What is your sense of where things stand at Tesla right now?
Yes, the EV sales environment has been challenged, but the market is shifting its focus to the robotaxi opportunity. So we're moving from 15% gross margins in autos, the hardware, to more of a SaaS model where robotaxis, recurring revenue model, is those margins are more in the 70s and 80s. And I think as analysts understand that that's where Tesla's going, and they start building in the model for robotaxis, they see a tremendous opportunity. So it's been interesting to me to see upgrades, even by some auto analysts, now that they're beginning to understand that this is not an auto company. Maybe they're working with their tech analysts and understanding the stock a bit better.
So when you think, though, about autonomous robotaxis and you think about robots, what does that look like? And is there an argument? Look, some of the critics would say, cars aren't working the way they're supposed to be working right now in terms of what's happening with the EV market. And some of these other ambitious efforts are going to take a long time to get to a meaningful escape velocity.
Well, we're keeping an eye on how quickly Tesla's footprint is expanding here. And it's expanding a lot faster, I think, than many people expected. And it's interesting to watch Waymo as well. We draw in Texas, we draw the footprint, and they're competing with each other. Competition is a good thing. So I think this is actually going to happen faster than most analysts think. In terms of the proliferation of robotaxis, especially if we get more federal legislation instead of just state by state. On the Optimus robot side, there's a lot of excitement in robotics. That in the private markets has been a huge space this past year. We look at an Optimus robot. Our chief futurist, Brett Winton, working with Sam and Daniel, have concluded that an Optimus robot is going to be 200,000 times more difficult to get working correctly relative to a robotaxi. So you'll have waves of Optimus improving with time, but full human is going to be quite difficult. Nonetheless, the robots that we're seeing, pick and pack and right. Lifting things, they're starting to make waves.
Should we talk about Bitcoin? Well, we can talk about SpaceX. I mean, that's going to probably go public this year. What do you think it's going to go public at?
Well, this next round is about $800 billion, so a near doubling. And we wouldn't be surprised to see it become the first $1 trillion company. And especially now that there's a new opportunity, data centers in space, to avoid all of the not in my backyard obstacles that Tesla and others are facing. So we're starting to do the modeling work on that.
Cathie Wood starts by reflecting on how volatile the past year was, with sharp moves up and down, yet she points out that several ARK funds still ended up among the top performers according to Morningstar rankings. What really matters here is how she describes those major drawdowns, particularly during the trade turmoil in April and later during the government shutdown. She frames those moments not as failures, but as buying opportunities where ARK leaned even more heavily into their highest conviction names. That mindset is very consistent with how ARK operates, and whether you agree with it or not, it explains why their portfolios can look so aggressive during periods of fear. One of the most important lessons she highlights is around inflation and valuations. Cathie Wood openly acknowledges that inflation looks like it is clearly coming down beneath the surface, yet the reported numbers still appear sticky. This disconnect is what has many investors nervous, especially with markets sitting near record-high valuations. Her argument is interesting because she looks back to historical periods like the 1990s and early 2000s, where markets continued to perform well even as valuation multiples compressed. In other words, prices can keep rising even if valuations gradually come down, as long as earnings and innovation continue to push forward. Personally, I think this is a reasonable point, but it also assumes execution remains strong across many sectors, which is not guaranteed. She makes it clear that ARK already assumes valuation compression in its bottom-up analysis of every company. At the same time, she sounds genuinely optimistic about inflation, surprising to the downside. She points to several deflationary forces working at once, including falling oil prices, housing price cuts like the 7% reduction from home builders such as KB Home, and sharply improving productivity. Unit labor costs, which were recently reported as negative on a quarterly basis, are a major data point she emphasizes. From her perspective, technology is the biggest deflationary force of all. Cathie Wood reiterates that ARK's entire focus is on technologically enabled innovation, specifically across 5 major platforms: robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing in healthcare. Her view is that all of these areas put downward pressure on costs across the economy. I actually agree with her on this point. Whether markets fully price it in or not, technology has consistently reduced costs and increased efficiency over long periods of time, even when short-term inflation narratives dominate headlines. The conversation then shifts to Tesla, which remains one of her most controversial and defining positions. She acknowledges that the electric vehicle sales environment has been challenging, but she argues that the market is now shifting its focus away from car sales and toward autonomy. This is where her thesis becomes very bold. She contrasts traditional auto margins of around 15% with what she believes will be a software-like recurring revenue model for robotaxis, where margins could reach the 70s or even 80s. According to her, once analysts truly understand that Tesla is transitioning from an auto manufacturer to a technology and platform company, the valuation framework changes entirely. She also notes that even traditional auto analysts are beginning to upgrade Tesla as they work more closely with tech analysts and adjust their models. My personal take here is that this is the crux of the Tesla debate. If robotaxis scale the way Cathie Wood expects, the upside is enormous. If they take much longer than expected or face regulatory hurdles, the valuation becomes far harder to justify. The opportunity is massive, but the execution risk is just as real. When asked about how quickly autonomy and robotics will actually roll out, Cathie Wood pushes back on the skeptics. She believes Tesla's autonomous footprint is expanding much faster than most people expected, and she points to competition with companies like Waymo as a positive sign. Competition, in her view, accelerates innovation. She also suggests that broader federal legislation, rather than a patchwork of state-by-state rules, could significantly speed up the adoption of robotaxis. On the Optimus robot side, she offers a much more measured take. She explains that ARK's research team believes getting a humanoid robot to function properly is roughly 200,000 times more difficult than deploying robotaxis. That is a staggering number, and it shows that even the most optimistic innovators understand the complexity here. She expects gradual improvement in waves rather than a sudden breakthrough. Still, she points out that robots focused on specific tasks like picking, packing, and lifting are already making meaningful progress and starting to impact real-world operations. Toward the end of the interview, the discussion briefly touches on Bitcoin and space-related innovation. Cathie Wood suggests that the next major valuation milestone in space-focused companies could be around $800 billion, with the potential to eventually reach a $1 trillion valuation. She also hints at new opportunities like data centers in space, which sounds futuristic, but fits neatly into her broader theme of exponential innovation opening up entirely new markets. The big takeaway from this interview is that Cathie Wood remains unwavering in her belief that innovation is deflationary, that technological platforms will reshape entire industries, and that short-term volatility creates long-term opportunity. Whether you agree with her projections or not, her framework is internally consistent. She is betting that the future will arrive faster than most people expect, and she is willing to tolerate volatility to stay positioned for that outcome. As an investor, I think the key is not blindly following her positions, but understanding the logic behind them and deciding how much of that risk and conviction aligns with your own strategy. Now, let's dive into the 2 high-potential fintech stocks you can start building positions in today with just $1,000. Think platform, not product. Moat, growth drivers, long-term relevance. Company 1 is SoFi Technologies, ticker SoFi. SoFi is building a single destination for your financial life, not just another bank or lending app. One intuitive platform to manage student loans, get a mortgage, open checking and savings, invest, even buy crypto. The draw is simplicity, lower friction, and a holistic view of your money. Win loyalty early, serve needs for decades. That is a compounding relationship model. The moat is an ecosystem where each new product deepens stickiness. Not a one-off transaction, but a member across checking, lending, investing, and more. As products per member rise, lifetime value climbs while cost per user falls. Brand strength with millennials and Gen Z drives efficient acquisition and trust. A full national bank charter is a structural edge, funded by member deposits instead of expensive capital. Lower cost of funds empowers competitive rates and better margins. Tech agility plus bank stability is a powerful operating model. Adjusted net revenue increased about 38% year over year. Adjusted EPS climbed from 0.05 to 0.11, a clear profitability trend. A record 905,000 customers added, up 35%. 1.4 million new products, up 36%, showing deeper platform adoption. Shares gained about 70% in 2025, nearly 400% over the past 3 years. Heading into the Jan 30 earnings, price pushed past $29 as expectations rose. Analyst consensus sits near $27 for 1 year. Bullish targets point to $35.70, roughly 35% potential upside. Volatility is possible, but the fundamentals trend in the right direction. The flywheel is intact. More users, better data, better products, more users. A member acquired through refinancing can return for cards, deposits, brokerage, and mortgages over a lifetime. A permanent shift to mobile-first finance creates a long runway for SoFi to scale. Modern, transparent, user-first positioning builds trust older institutions struggle to match. Elevated expectations heading into earnings reflect confidence in profitability and platform reach. As acquisition costs scale and deposits fund lending, operating leverage drives earnings power. Track user adds, products per member, and margin progression each quarter. SoFi continues to position itself as one of the most aggressive fintech disruptors in the market, leveraging its digital-first platform to offer lending, banking, investing, and financial services under one ecosystem. The company currently carries a market capitalization of approximately $33 billion and trades at a price-to-earnings ratio of about 46.66. Earnings per share stand at 56 cents, reflecting improving profitability as the business scales. In 2024, SoFi generated total revenue of roughly $2.61 billion and delivered net income of approximately $479.13 million, signaling a meaningful shift from growth at all costs towards sustainable earnings. SoFi Technologies, SoFi, matters because it is building the financial operating system for a generation. Execution plus bank-chartered funding can translate growth into durable free cash flow over time. Now that we covered a US super app, let us pivot to Latin America. First, a quick message. Stay focused. The next company is a digital bank with scale most competitors can only dream about. Now we shift to a much bigger population base with lower legacy penetration. This video is brought to you by Value Stocks Investing Master Course. If you are looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. We are crossing into markets where mobile-first banking is a leapfrog technology. Think massive TAM, underbanked users, and a brand people love. Let us break down why the next company matters first, then numbers. Moat, growth drivers, long-term relevance, same framework. Ready for scale at continental levels. User adoption here can move billions of dollars in value over time. Let us dive in. New Holdings, ticker NU, is the leading digital banking platform in Latin America, operating at scale in Brazil, Mexico, and Colombia. For decades, high fees and poor service left many underbanked. NU changed that with no fee, digital-first banking, and accessible credit. Simple products that solve real problems for everyday people. Over 110 million customers in Brazil alone, a dominant position that is hard to replicate. Scale fuels better credit models, personalization, and product innovation. Beloved consumer brand drives low-cost growth as friends recommend friends. In Mexico, growth from a standing start to 13 million customers. In Colombia, already reaching about 10% of the population. A repeatable playbook and scalable tech across the region. Shares exploded 61.6% in 2025, up almost 64% in the past year, setting a new intraday record high near 17.85 and closing near 17.94. Market cap around $80 billion and rising optimism after earnings beats. Net income roughly $2.53 billion on about $6.36 billion in revenue. Transition from cash burning to cash generating powerhouse. NU is moving to acquire a small bank in Brazil. Licenses can improve regulatory navigation and unlock broader product sets. Think more investment options and diverse credit products over time. fair value narratives point near 18.43 per share versus a recent 16.56, implying a discount after a pullback. High expectations are priced in, so hiccups can pull shares back. Focus on the business trajectory, customers, monetization, and leadership. NU unlocks dormant demand by delivering simple, cheap, transparent banking at scale. As users adopt more products, revenue per user and profitability expand. Expansion into Mexico and Colombia is a long runway for growth. NU Holdings represents a different but equally compelling fintech story, focused on digital banking across Latin America, with massive user adoption and expanding margins. The company holds a market capitalization of approximately $80.46 billion in trades, at a price-to-earnings ratio of around 31.93. Earnings per share also come in at 52 cents. In 2024, NU Holdings produced about $8.26 billion in revenue, while generating net income of roughly $1.97 billion. These results highlight a fintech platform that has successfully scaled profitably, positioning NU as a long-term winner as financial services continue to shift toward mobile-first and low-cost digital models. NU Holdings matters because it is digitizing finance for the masses across Latin America. Brand love and first-mover scale create a moat that compounds adoption and cash flow. Two different geographies, one shared theme, durable network effect platforms. Let us translate all this into a simple $1,000 plan. Actionable next steps coming up. With $1,000 you can split $500 into SoFi and $500 into NU to diversify across models and regions, or pick the story that fits your conviction and allocate the full amount. Hold with a long-term mindset. Track user growth, products per user, and profit margins. For NU, watch expansion momentum in Mexico and Colombia. Monitor regulatory steps and acquisitions that expand capabilities. Which of these two businesses do you believe has the stronger long-term advantage, and why? Drop your answer in the comments. No single right answer. Share your take, and let us learn together. Both stocks can be volatile. Think in years, not days. Only invest what you can hold long-term. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.